We've got Uwe Parpart. He joins us now from Hong Kong. He is chief economist and strategist for Asia at Cantor Fitzgerald. So, Uwe, is this a signal that Chinese authorities see assets at these banks deteriorating?
Well, look, we've had very, very rapid credit growth. We've had growth in the M2 money supply that reached at one point almost 30% in late 2009. It's now been built back down to about 17%. But even that is still faster than nominal GDP growth. And anytime you have faster credit growth than nominal GDP growth, something's got to give. This will show up in the form of non-performing loans without any question. So the need to make sure that there is a good capital cushion definitely exists. And there's a whole lot of risk, especially in the real estate sector and the property sector, to which the Chinese banks have very large exposure. Of about 20% of their loan exposure is to property.
And we understand also, Uwe, that the Chinese regulator is stress testing these Chinese banks for a property crash, for a correction of 30 to 50%. Is that something that could actually happen?
Well, look, I looked over the weekend at this in some detail and compared it to what was going on in Japan in the 1980s, between 1985 and 1988. So from the time of the Plaza Accords that pushed up the value of the yen until Japan, finally crashed and the Nikkei came down from 40,000 to levels where it's now. In that period of time, property prices actually decreased by more than 50% in certain areas, especially in commercial real estate in Tokyo. So a 50% decline in some major centers is not out of the question. I'm not forecasting that, I'm not predicting that, but this is certainly the necessary caution that the Chinese regulator is taking to make sure that we have no replay of the lost decade of Japan.
What sense do you get of how comfortable investors are with the level of tightening that we're seeing from the Chinese? Do you think that perhaps the risk of a hard landing has increased?
Well, I'm not sure that the risk of a hard landing has increased because unlike, say, Ireland, which had a major banking crisis, or Spain, which is still coping with one, China has tremendous backup. It has $3 trillion worth of FX reserves, and it has previously used those FX reserves to recapitalize the banks. So from the standpoint of overall sovereign risk and from the standpoint of banking risk that is uncontrollable, this is not a major issue. On the other hand, obviously, if the capital ratios rise further, if capital ratios have to be increased by the banks, and if we see further interest rate increases, there will be a certain degree of economic slowdown, which is intended. So nothing necessarily to worry about.
Uwe, quickly, we've got the Fed this week. That's going to be a big point for the markets. You call monetary policy currently the greatest global risk. Why do you say that?
Well, look, if we look at what Ben Bernanke is supposedly has rehearsed the answers he's going to give at his press conference on Wednesday, whether or not that has occurred, I don't know. But if he listened to Monsieur Trichet, then he should have realized that at 2.7% inflation, which the U.S. is running right now, directly the same as Europe, you might consider raising interest rates. Bernanke's response has been inflation. What inflation? Because the Fed, unlike the ECB, is looking at so-called core inflation. Clearly, yes, if you do that in the United States, then you're looking especially at sectors where there is disinflation, such as the real estate sector, and that's highly weighted. So Bernanke could be making a big mistake there by not actually getting rid of this quantitative easing flood of liquidity that's been hitting the world, and that has led to the necessity of interest rate increases all over the place, and obviously to slow down.
So you're worried they'll wait too long. All right. Uwe Parpart, thanks very much for joining us.